Hey, Andy, thank you so much for joining me today. I really appreciate it.
Thank you, Joe, for having me. I'm delighted to be here.
Let's start with tell us a little bit about yourself and who you are. I'll start with a quick intro. Andy Sirkin, if there is such a thing, the household name of TICs, Tenancy and Commons in San Francisco. I've discovered you early on in my career through just Googling, and it's impossible to not find your name everywhere. And through MLS and people's MLS remarks that this is a Sirkin TIC agreement and all that good stuff. So you're basically the go-to authority on tenancy and common, at least based on my perspective, in San Francisco. Tell us a little bit about yourself and kind of how you got into this.
I graduated from law school in 1984 and went to work for a large law firm in San Francisco. Relatively shortly after that, I became interested in TICs because I wanted to buy my first home with my wife. At that time, homes in San Francisco were about $200,000, which by today's standards, of course, sounds ridiculously cheap. But back in those days, $200,000 was a lot of money. We didn't get paid so much. And so there was no way that we could afford one except to group together with some other people who were in a similar situation. And that's what we did. So I got together with some other people and bought an apartment building, moved in, and that led to inquiries from other people I worked with, people I knew, people who worked with other people who were in our group, and so on. That led to requests to put other groups together. And by a year or so after that, I was doing a lot of TICs. And by 1988, I was doing it full time. I would say that my path toward TICs was probably very similar to the path of most of my clients, which is we were looking for a more affordable way to become homeowners.
So that was the early days of TICs. And it's since then, it's become quite popular in San Francisco and people see these a lot. If you can kind of go into and explain and describe what is tenancy and common ownership, and maybe how does it differ in a market like San Francisco where it is readily available for sale as tenancy and common units, for instance?
The most significant thing to understand about tenancy in common, and really the key to all the other things that we'll probably talk about today, is that tenancy in common just describes a relationship between people who own something together. So in other words, in the typical San Francisco tenancy in common, you have anywhere from 2 to maybe 20, 25 people who all share ownership of a property. It can be a lot with multiple houses on it, an apartment building, a lot with 2 apartment buildings, or anything really. And all those people are on the title to the property. And each person holds their ownership percentage of the property as a tenant in common, which means that they decide who their interest goes to when they die, compared with, for example, a joint tenancy where you don't get to make that decision. So that's the key aspect of tenancy in common, that these people are sharing ownership of something without anyone owning a particular part of the thing. And that's what's the difference between a tenancy in common and, say, a condominium, because in a condominium situation, the property's actually been legally divided. So there's a separate title for each unit in the property or each home on the lot. That doesn't happen in a tenancy in common. It's undivided property. You just have a bunch of people that all own it together. And then they have a private agreement among themselves that determines who gets to live where, who gets to use what, who pays what percentage of this or that, and so on. And it's the fact that a tenancy in common ownership arrangement is undivided property that makes it legally possible. It makes it possible to do it anywhere, as opposed to only those places where an apartment building can legally be divided into condominiums. And as you know, Joe, many places have enacted restrictions or outright prohibitions on taking existing parcels or existing apartment buildings and dividing them up into condominiums. Or if they allow them, they have lottery systems or they're really expensive. And so tenancy in common is a way for people not to get around those requirements because you're not dividing the property with a tenancy in common, but to create a living arrangement that feels like a condominium situation in many ways, even though it isn't, because the building hasn't actually been divided. That lack of division is what keeps it out of the realm of public regulation.
So much to unpack there. Tenancy in common clearly is something that just, in San Francisco at least, was born out of necessity for a lot of people because prices for buying real estate have been so high for so long. But one of the things, if you can go over kind of the early days of financing for tenancy in commons, how people were getting it done, and maybe go over the evolution of kind of what it looks like today.
So back when we first started doing these in the mid 80s, there were no special financial products for tenancies in common. They were just basically apartment building loans. And so what the group of owners did was that they jointly applied for one of these loans. So if it was let's say a 4-unit building, all 4 of the owners would go to a bank and apply for an apartment building loan. Assuming they got approved, they would buy the building, and they would all have their names signed on the loan as co-borrowers on the loan. And then they would each owe a percentage of the monthly payment and eventually the repayment of the principal of the loan. And in their tenancy in common agreement, they would have a payment structure, which essentially is another way of saying there would be a budget and there would be monthly dues for each owner. But the interesting thing from the standpoint of financing is that because it was group financing, one shared loan, the loan payments of each owner would be part of their monthly dues. So each owner would pay their monthly dues, and then the group as a collective would take the monthly mortgage payment from that collected amount and send it off to the bank. And that type of financing remains viable today. There still are people even today that finance it that way. But beginning around 20 years ago, lenders started to provide a different sort of financing product for tenancy in common. And the difference was that instead of having one loan where all the owners were co-borrowers and that was secured by the entire property, they offered fractional loans, meaning that each individual owner could get their own loan secured only by their percentage of the property. Now notice I didn't say secured by their unit. Why didn't I say that? Because in a tenancy in common, no one owns a unit. Everybody owns a percentage of the property. So in our hypothetical 4-unit building, let's say to keep it simple, it was divided into 4 25% shares. Owner A, their loan would be in their name, would be the only borrower, and the security for their loan would be their 25% interest, meaning that if they defaulted on the loan, the bank would foreclose on that 25% only, and it wouldn't affect the other 3 owners who had their own loans secured by their own respective 25% shares. As I say, that fractional financing model first became available in the early 2000s, so roughly 20 years ago. But it took a while to catch on, both in terms of people becoming aware of the viability of this or the availability of it, and also in terms of lenders offering more attractive products and more lenders getting involved so that there was more competition and so on. And so what we saw between, let's say, 2000 and 2008 was a sort of gradual growth in the fractional loan marketplace, to the point where by 2008, we had 8 or 9 banks providing these financing options. There was quite a bit of competition, and so that made it a little bit easier to get these loans. It made the terms more attractive. And then we had the big financial crash in 2008. And if you recall, Joe, there was a lot of consolidation in the bank market. Little banks were bought by big banks, banks went out of business, and so on. And because most of the banks offering fractional loans were small community banks, we lost a lot of lenders at that time. It took a while for the market to recover. Now, the good news was that even in the worst parts of the financial crisis, it's like 2009, 2010, we still always had at least 2 to 4 fractional lenders in the market. But we've never actually gotten back to the 8 or 9 that we had back in 2007, 2008. I believe right now there's 6 lenders offering fractional loans in the Bay Area. And I would say today that probably 80 to 90% of all TICs use fractional financing. The other 10 to 20% are still using group financing. Now, you may wonder, why would somebody still use group financing when fractional financing is available? And there are some reasons why people want it. The primary reason being pricing. It can be less expensive. And the secondary reason being terms. You can still get a 30-year fixed rate loan if you get a group loan. But so far, at least, there's no such thing as a 30-year fixed fractional loan. That product is not yet available. So if you're going to get fractional financing, you're looking at a fixed period of anywhere from 3 to 10 years, after which it's going to become a variable rate loan. So if you're one of those people that feels it's really, really important to lock in your rate for 30 years, then you go with a group loan.
Thank you. That was very comprehensive. So it makes sense that, in the evolution of this, that in your example, a 4-unit building, the risks initially were, what if one person doesn't pay? that could destroy the credit and cause big issues for the other three people who are paying. And with the invention of fractional loans, it has eliminated that essentially.
If might interject, Joe, about that point, that actually was not the biggest problem with a shared loan. It is, as you correctly recognized, a risk, but we built in all sorts of protections in the agreements so that we weren't dependent on each person making their payment each month. The groups had large reserve funds and so on. So we never actually had a situation where there was a default and a foreclosure on a group loan. Actually, the real problem with group loans is resale. In other words, what happens is an owner inevitably wants to sell at some point, pretty much always within the first 5 years, some owner is selling. It puts the group in a position where they need to refinance the group loan. And that's expensive, it's time consuming, and you have a number of issues that you have to figure out: who pays for what if somebody has bad credit, and so on. While the theoretical problem with group loans is the default problem that you mentioned, the real problem that comes up all the time is not default, but resale. Perfect. And we also like to tell people now that, let's keep with our 4-unit example for a moment. In a 4-unit situation, the difference in value when somebody sells their TIC interest between having a fractional loan TIC and a group loan TIC is 20 to 25%. In other words, when you go to sell your TIC share on the market, if you have a group loan, you're going to get 20 to 25% less money for your TIC share than if you had a fractional loan.
That leads me to my next question, a follow-up, is condo conversion. So why is this something that is desirable? Tell us a little bit about what that process looks like in San Francisco.
Sure. Let me start with the desirability question. Why do people want to convert to condominiums? And I would say there are several reasons. The first one is really the same kind of financing issue or issues that we've already been talking about. You have a relatively limited supply of fractional loans from a relatively small number of lenders, and therefore not a lot of product choice. Underwriting guidelines are tougher, down payment requirements are higher, and so forth. You get into a condo situation, you basically have every loan in the world available to you. And so you're going to be able to get those 30-year fixed, 3% down, ultra easy underwriting guidelines, and so on. So there's a huge advantage between a condo and a TIC from the standpoint of availability of financing. So I think that's reason number one. Reason number two is education. Even though now we have 30 years or so, or 35 years of TICs under our belt, and most buyers and agents are familiar with the product, there still are a lot of people out there who either don't know what a TIC is at all, or only know enough about them to be spooked by the whole idea. And so you have still a smaller market for TICs than you do for condos. And so from a marketability standpoint, I think there is an advantage. A third reason we used to always cite was price. In other words, we used to say that the condos were worth more than the TICs. And I think under certain market conditions for certain properties in certain neighborhoods of San Francisco, that remains true, that condos are worth more. But it definitely is not a foregone conclusion these days. And in many neighborhoods in San Francisco, for many types of buildings, especially your more attractive Victorians and Edwardians and things like that, that are not being developed as new properties. For that type of property, it may well be the case today that there is no price differential between a TIC and a condo. So the idea that you would gain value from converting, I think, is a bit antiquated. It's not that you don't necessarily gain value, it's more that it's a property by property thing. In some cases you will, in some cases you won't. So let's go to the second part of your question, which is how do you do it? This is an actually complicated question because the rules have changed a lot. It used to be the case that we had two systems for conversion. We had a lottery-based system that was available for 2 to 6 unit buildings where you had to own or occupy for a period of years, then win a lottery and then convert. And the other alternative was a non-lottery system that was available only for 2 unit buildings where both units were owner occupied. What happened was the lottery system became clogged up. In other words, you had so many people trying to win the lottery that it was taking people 11, 12 years to win. Back in 2012, 2013, the Board of Supervisors and the mayor enacted essentially if you will, an amnesty program or a grandfathering program where they suspended the lottery in an effort to get through this huge backlog of people that have been waiting many, many years. And that was called the ECP, or Expedited Conversion Program. And that lasted from 2013 until 2020. So it's ended now. But the lottery system has not come back yet. The reason was, as part of the political deal that was necessary to create the ECP program, one of the concessions that had to be made was that when ECP ended, there would not be a lottery for a number of years, so that the total number of conversions that occurred over, say, a 20-year period would not be any higher than it would have been. And so essentially now we have no lottery system because we're waiting to catch up in terms of number of conversions to where we would have been had there been a lottery going on right along. We don't know exactly when the lottery will return, but we know it will either be 24, 25, or 26. And when that happens, buildings of 2, 3, and 4 units in size will be able to enter a lottery once more. Buildings of 5 and 6 units that used to be able to enter the lottery will no longer be eligible. Theoretically, that will cause there to be less competition in the lottery. The second big change with the new lottery, when it comes back, is that the owner occupancy requirements will be higher. Now it will be all but one of the units that need to be owner occupied. So for example, in a 4-unit building, 3 of the 4 will need to be owner occupied. It used to be only 1 of the 4. In a 3-unit building, 2 of the 3 will need to be owner occupied. So when the lottery comes back, it will be harder to enter, but presumably easier to win. And then at that point, we'll have, again, the 2 systems, because the 2-unit lottery bypass system, that has continued straight along, and that still exists today.
So you mentioned the 2-unit bypass system, and then you also mentioned 2 units in the lottery system. And it sounds to me that the only difference between those two would be in the 2-unit bypass system. That means the requirements are both units are owner occupied for at least a year and they meet some of those other qualifications. Whereas the lottery, it's as long as it's occupied by one person owning, then they can go into the lottery there for a 2-unit. So there's really 2 ways to do a condo conversion for 2 units. Basically 5 units plus, or at least for the foreseeable future, are not going to be allowed to condo convert.
That's correct.
Okay. Obviously this is March 4th, 2021. So for the last almost year now, we've had this thing called the global pandemic. Has that had any significant changes on the condo conversion process in San Francisco? Well, primarily that would be the bypass system during this time.
No, we've seen the condo conversion process continue. Obviously, a lot of people are working remotely, both in terms of the professionals that are assisting clients with their conversion and also in terms of the people in the city who process these applications. So the processing has slowed down a bit from where it was immediately before the pandemic. But by historical standards, it's still quite fast because the number of applications to be processed is much, much lower now, since you've got most of the ECP conversions are finished or are in their final stages. There is no lottery. So the only people in this process are the 2-unit people. It's a relatively small number of conversion applications. The staffing level at the Department of Public Works has not really gone down. So I would say historically, processing is relatively fast, although maybe slightly slower than it would be in the absence of the pandemic. I think the really interesting impact that the pandemic has had is on the TIC market rather than on the condo conversion market. Would you like me to go into that?
Yes, please. Yeah.
As a result of the pandemic, you've had a lot of people move out of the city and rents have dropped dramatically. Depending on who you listen to, anywhere from 25 to 35% rents have gone down, and you have a lot of vacancy. You have landlords who have units on the market for long periods of time, and then their applicant pool is relatively small and the rents that they're getting are relatively low. But at the same time, you still have rent control. So if I'm a landlord and I find a modestly desirable tenant who I'm able to rent it to at, say, 35% below what I thought was market rate pre-pandemic, and I have rent control, I'm stuck with that tenant at that rent forever. So landlords are looking at this situation and saying, does it make any sense for me to lock in a 35% below market rent for the rest of this person's life, where I can only raise my rent maybe 1% or 0.5% a year? And a lot of landlords are looking at that option and saying, that's not really a very good deal for me. And so what landlords are doing is some of them are just leaving their units vacant, but other people are looking at TICs as a way out of that problem. They're taking these vacant units and they're offering them as TIC interests. Already, of course, TICs had a higher value than the units did at market rent because owner occupancy was highly desired in San Francisco. And so you had a lot of buyers with a lot of money going after those units. But when you factor in the rents have dropped 35%, meaning that the value of income property presumably has also dropped 35%. Condo prices have not dropped 35%. They may have dropped slightly. You see that this differential between the value to an investor of an apartment building and the value of the same apartment building to owner occupants is enormous. It's grown exponentially during the pandemic. Obviously, the market has responded to that. And the way the market has responded to that is we've seen a huge uptick in the number of requests for agreements and the number of people inquiring about potential use of their building as TICs. And, an additional silver lining to all this is that these TICs typically don't involve any evictions because the units are already vacant. People have already moved out of them. So this isn't a situation where tenants are being displaced in order for owner occupants to move in, which is the traditional objection to TICs. What's going on during the pandemic is vacant units are simply being repurposed for owner occupancy rather than tenant occupancy.
That's an interesting perspective. That sounds to me like another great path towards affordable home ownership for a lot of people who otherwise would be priced out of the city.
The world of housing in a place like San Francisco or Los Angeles, it's always a zero-sum game because these are places where we have fairly strict limits on what can be built new. We have a bunch of older housing, which is much more highly desired than new housing. And so, you have a relatively limited supply and you have a lot of people competing for it. And that group of people competing for it includes people who want to own and people who want to rent. So you've got a bunch of competition for this commodity, which is in limited supply. And so inevitably, there's going to be winners and losers in that game. And tenancy in common is just another way the game is played, essentially. If we took tenancy in common off the table, people would find still another way to do it. Anytime you have a bunch of people competing for something that is in limited supply, whether it's, residency in the United States, or whether it's housing, or whether it's food, or whether it's jobs. Unfortunately, the reality is there's always going to be winners and losers. And whenever people talk about TICs, oftentimes I'm always concerned that they're looking at it in isolation without looking at it, for example, in the context of rental apartments, right? You've got tenants that successfully get the apartment and tenants that get rejected. You have people that are lucky enough to have a rent-controlled apartment because they don't have a growing family or a changing job, so they can stay there forever. And people who are moving into the city or unlucky enough to have to move, who have to pay much higher rents than they would have had to pay in the absence of rent control. All of these things are trade-offs. And I think that a lot of times when people discuss TICs or even housing in general, they tend to take a very narrow perspective without looking at the overall conditions that are affecting everybody in this marketplace.
I think that is a major problem in housing, but just in life in general is it takes a little bit more mental bandwidth to do more research and look at things from a more holistic perspective and see how certain things affect other things instead of just a narrow viewpoint and then jumping to conclusions and attacking and, having all this difference. But that's a conversation for another day. Andy, thank you so much for joining me. I really appreciate it. And you and your firm, you help people in San Francisco and it sounds like all over the world draft up TIC agreements, handle condo conversions, and really just help people with everything related to this process. How does somebody who's watching this and found this valuable, how do they get in touch with you? What's the best way?
So I would say that most people contact us either by email or by phone. The email address to contact me is Andy, A-N-D-Y, at andysirkin.com, ANDYSIRKIN.com. You can also visit our website, which is at that address. We have quite a lot of free information there, not just about the type of tenancy in common we've been talking about today, but also about some of the other things we do, like equity sharing, vacation home sharing, co-housing, intentional communities, and so on. So we have quite a lot of information there for people to browse. And of course, we welcome visitors as well as people contacting us by email. And as I mentioned, you can also call us. My direct line is 415-462-5925. So looking forward to hearing from some of your viewers.
Thank you very much. And we'll have all of that information in the description to this video.
Thank you, Joe. It's been a pleasure to be with you.